This account offers three distinct tax benefits simultaneously. Contributions are tax-deductible or pre-tax. Investments grow completely tax-free over decades. Qualified withdrawals are also entirely tax-free. No other retirement vehicle provides this triple benefit. A 401k or traditional IRA only offers two of these advantages. A Roth IRA only offers tax-free growth and withdrawals. The health savings account is the only exception under current tax law. It functions as a powerful, hidden retirement fund. Maximize your contributions immediately if you qualify. This strategy accelerates wealth accumulation significantly. To open an HSA, you must enroll in a High Deductible Health Plan. The Internal Revenue Service defines minimum deductibles and maximum out-of-pocket costs annually. For 2024, the minimum deductible for self-only coverage is $1,600. Family coverage requires a minimum deductible of $3,200. Contribution limits are also set by the Internal Revenue Service each year. In 2024, the maximum contribution is $4,150 for individuals. Families can contribute up to $8,300. Individuals aged 55 or older can contribute an extra $1,000 catch-up amount. Contributions must cease once you enroll in Medicare. The first tax advantage is the contribution mechanism itself. Money deposited into an HSA is either pre-tax or tax-deductible. If funded through payroll, the money avoids federal income tax. It also bypasses FICA taxes, including Social Security and Medicare. This FICA tax avoidance is a unique benefit compared to traditional IRAs. If funded directly, the contribution is an above-the-line deduction. This deduction reduces your adjusted gross income immediately. Lowering your AGI can qualify you for other tax credits. This immediate tax reduction boosts your current cash flow significantly. The second advantage involves the investment growth phase. HSA funds can be invested in stocks, bonds, and mutual funds. These investments compound over time without taxation. You pay zero capital gains tax on realized profits inside the account. Dividends and interest earned are also shielded from annual taxation. This tax deferral allows your money to grow exponentially faster. Compare this to a standard taxable brokerage account. In a taxable account, you lose a percentage of gains every year. The HSA structure maximizes the power of long-term compounding. The third and most powerful benefit is the tax-free withdrawal. Withdrawals used for qualified medical expenses are never taxed. Qualified expenses include deductibles, co-payments, and prescriptions. Dental and vision care costs are also covered under this rule. This tax-free withdrawal applies regardless of your age. You must maintain detailed records of all medical expenses. These records substantiate the tax-free nature of the withdrawal. This creates a permanent tax shelter for healthcare costs. After reaching age 65, the HSA rules change dramatically. The account essentially converts into a traditional 401k or IRA. You can withdraw funds for any purpose without penalty. If the withdrawal is not for medical expenses, it is taxed as ordinary income. This is the same tax treatment as a traditional retirement account. However, if you use the funds for qualified medical costs, they remain tax-free. This dual functionality makes the HSA superior to other accounts. It provides tax-free healthcare funding or flexible taxable income. The optimal strategy is to treat the HSA purely as an investment vehicle. Pay current qualified medical expenses using cash or a credit card. Do not withdraw funds from the HSA for these immediate costs. Save all receipts for every qualified medical expense incurred. You can reimburse yourself tax-free decades later. This allows the invested HSA funds to grow for the maximum duration. This strategy is known as the receipt arbitrage. It maximizes the tax-free compounding period. This turns the HSA into a massive tax-free emergency fund for retirement. Using HSA funds for non-qualified expenses before age 65 incurs severe penalties. The withdrawal amount is taxed as ordinary income immediately. Additionally, a 20% penalty tax is applied to the distribution. This penalty is significantly higher than the 10% penalty for IRAs. Strict adherence to qualified medical expenses is mandatory before age 65. After age 65, the 20% penalty disappears entirely. However, non-medical withdrawals are still subject to income tax. Understand the Internal Revenue Service rules regarding dependent care expenses carefully. Healthcare costs consistently outpace general inflation rates. The HSA provides a crucial hedge against rising medical expenses in retirement. The ability to invest tax-free combats the erosion of purchasing power. Future legislation could potentially alter HSA tax benefits. Current political consensus generally supports the HSA structure. Maximize contributions now while the triple tax advantage remains codified. This account is arguably the most powerful wealth-building tool available today. Start funding your HSA immediately to secure your financial future.